The IRS is not sitting around waiting for you to slip up. It is already examining your home. Right now, tonight, while you are watching this, a system built with $80 billion in federal funding is actively cross-referencing your county deed records, your mortgage lender reports, your home equity loan statements, and your tax returns simultaneously, searching for discrepancies you may not even know exist on your own paperwork. And the seniors being flagged most frequently are not people who cheated the system. They are people who made completely ordinary decisions about their homes, decisions that nobody ever sat them down and explained carried a tax reporting requirement attached to them. Adding a family member to the deed, taking out a home equity loan to cover medical expenses, renting a spare bedroom for a few $100s a month, inheriting a property from a spouse and simply continuing to live in it. Every single one of those actions can trigger an automatic IRS flag in 2026. And by the time the notice arrives in your mailbox, the analysis is already finished. The IRS is not reaching out to ask whether a problem exists. They are informing you that they have already located one. Today, we are going to walk through the 4 specific property transactions that are triggering automatic IRS flags for senior homeowners right now. We will cover what the penalty structure looks like when a flag becomes a formal notice, and the 5 concrete steps that can protect you before any of this reaches your front door. Stay with us, because at the 7-minute mark, we are going to show you the one decision that millions of seniors made with genuinely good intentions to protect their home and help their family. A decision that is now costing them tens of thousands of dollars in completely avoidable taxes. Which state are you watching from right now? Drop it in the comments below. What changed and why this level of enforcement simply did not exist 3 years ago? Before we get into the 4 triggers, you need to understand the shift that made all of this possible, because the degree of IRS scrutiny that senior homeowners are now facing is genuinely unprecedented. For decades, the IRS operated under serious constraints: a limited budget, outdated technology, insufficient personnel to meaningfully verify whether what appeared on your tax return matched what was actually happening in your financial life. Audit rates dropped to the lowest levels in modern history. Compliance gaps went undetected for years at a time. Millions of seniors made entirely normal financial decisions about their homes without anyone ever informing them that those decisions carried specific tax reporting requirements. That era is over. Congress authorized approximately $80 billion in new IRS funding. A significant portion of that money went directly into enforcement infrastructure and technology development. The IRS deployed it to construct automated data matching systems that connect information from sources that had never previously been linked together. County property records, mortgage lenders, home equity loan servicers, title companies, short-term rental platforms, estate and probate court filings. All of that data now feeds continuously into machine learning systems that compare it against every tax return associated with the property owners involved. The system is not hunting for suspicious or fraudulent behavior. It is performing mathematical comparisons, looking for gaps and inconsistencies. A deed transfer with no gift tax form on file, rental income reported by a platform with no corresponding entry on your return, a home equity loan interest deduction that does not align with how the borrowed funds were actually used, an inherited property sale with no documented cost basis. These are not discretionary judgment calls made by a human reviewer. They are automated calculations. The system operates around the clock. It processes millions of records at once. And when it identifies a discrepancy, it generates a notice automatically, without any human being reviewing your file first. Did you know the IRS is actively cross-referencing deed records against tax returns right now? Leave a yes or no in the comments below. Trigger 1, the home equity loan interest deduction mistake. This is the trigger generating the highest volume of notices for senior homeowners right now, and it catches people off guard precisely because it seems so straightforward. Over the past 3 years, inflation has driven up the cost of groceries, utilities, prescription medications, and basic everyday living expenses in ways that have put real pressure on fixed incomes. Millions of seniors have turned to their home equity as a practical financial resource. A home equity loan or line of credit to pay off credit card debt, to help a grandchild with college tuition, to cover a medical procedure that insurance did not fully pay for, to handle home repairs that could not be deferred any longer. Those are completely rational, understandable decisions. Nobody would question the logic. But here is what most lenders never explained at the closing table. Under current federal tax law, specifically the Tax Cuts and Jobs Act of 2017, which remains fully in effect, home equity loan interest is only deductible if the loan proceeds were used to buy, build, or substantially improve the home that secures the loan. IRS publication 936 states this clearly and without ambiguity. If you use the funds for anything else, medical bills, debt consolidation, tuition payments, everyday living expenses, the interest is simply not deductible, period. And if your tax preparer claimed that interest as a deduction on Schedule A of your return without first verifying how the borrowed funds were actually used, you now have an incorrect deduction sitting on a filed return. One the IRS can identify directly through their lender data matching systems. Here is how it works. The lender reports the loan to the IRS. The IRS then checks whether the stated use of those funds aligns with the deduction claimed on your return. When those two things do not match, the notice is generated automatically. The financial consequences begin with the additional tax owed on the improperly claimed deduction. Then add interest calculated from the original due date of the return in question. Then add a potential accuracy-related penalty of 20% of the total underpayment. For a senior living on a fixed income, that combination, back taxes, interest, and penalties stacking on top of each other, can easily reach several $1,000s from a single filing year. Trigger 2. Adding a family member to your home deed. This is the trigger that is costing seniors the most in long-term financial consequences. And it is one of the most common things seniors do, with entirely good intentions. Millions of homeowners have added an adult son or daughter to their property deed, so the house transfers to them automatically upon death, bypassing the probate process entirely. Someone told you it would shield the home from Medicaid recovery. You simply wanted to make things easier for your family after you were gone. Those motivations make complete and human sense. But from a tax perspective, what you did is something the IRS views very differently from a simple administrative update. Adding someone to your deed is a transfer of a partial ownership interest in real property, and the IRS treats that transfer as a gift. Under the Internal Revenue Code, the transfer of property by gift is a reportable and, in many cases, taxable event when the value transferred exceeds the annual gift tax exclusion. For 2026, that exclusion is $18,000 per recipient. If your home is worth $400,000 and you added your child as a 50% owner, you transferred $200,000 in value in a single transaction. That means you are required to file IRS Form 709, the United States Gift and Generation Skipping Transfer Tax Return, for the year in which that transfer took place. Not filing that form when you were required to is a reporting violation with its own separate penalty structure. But the consequence that matters most is not the penalty for the missed filing. It is the long-term tax damage that flows from the decision itself. When you give property as a gift during your lifetime, the person receiving it inherits your original cost basis, not the current market value of the property. This is called carryover basis. But when someone inherits property at your death, they receive what is called a stepped-up basis, meaning their cost basis is reset to the fair market value of the property on the date you passed. Here is what that difference looks like in real dollars. If you purchased your home for $80,000 30 years ago, and it is now worth $400,000, your child inheriting it at your death would receive a stepped-up basis of $400,000. If they sell the property at that value, they owe zero in capital gains tax. But if you gifted them a 50% interest while you were alive, their basis on that half is only $40,000, your original cost basis for that portion of the property. When they eventually sell, they would face capital gains tax on the difference between $40,000 and whatever the home is worth at the time of sale. We are talking about tens of thousands of dollars in entirely preventable tax liability, created by a decision made with completely good intentions, but without the full picture of what it meant from a tax standpoint. And the IRS is now identifying these unreported gift transfers automatically. County deed records feed into the federal database in real time. When a deed change appears in those records but no corresponding Form 709 was filed, the system flags it immediately. If you added a family member to your deed in the last 5 years, hit the like button right now, because the next section tells you precisely what to do about it. Trigger 3, rental income from your primary residence. This trigger has expanded dramatically in recent years, and almost entirely because of how accessible short-term rental platforms have made it to generate extra income from a spare room or an unused portion of your home. For seniors on fixed incomes, a few $100s per month from renting a spare bedroom can be genuinely significant. It can mean the difference between covering property taxes comfortably or falling behind. It can fund prescription medications or help with a grandchild's expenses. The appeal is completely understandable, and the decision to do it is entirely reasonable. But the moment you begin receiving rental income from any portion of your primary residence, you have legally changed the tax character of that portion from personal use to income-producing use. That change carries specific mandatory obligations. The rental income must be reported on Schedule E of your federal tax return. Expenses must be properly allocated between the personal use portion and the rental use portion of the home. And critically, you must account for depreciation on the rental portion, which affects your cost basis in the property and therefore determines how much taxable gain you will have when you eventually sell. Here is the reason the IRS catches this automatically without conducting a traditional audit. Platforms like Airbnb and VRBO are legally required to issue Form 1099-K to any user who receives more than $600 in gross payments during the calendar year. That form is sent simultaneously to you and to the Internal Revenue Service. If you received rental income through one of these platforms and did not report it on your return, the IRS does not need to investigate or audit you to discover the gap. They already have the data sitting in their system. The matching process handles the rest. The most common outcome is a CP 2000 notice, an automated underreporter notice. It is not technically classified as an audit, but in terms of the financial pressure it carries, the distinction is largely academic. It is a computer-generated assessment that presumes you owe the tax on the unreported rental income, plus interest, plus a potential accuracy-related penalty. And if you do not respond within 60 days, the proposed assessment becomes final. At that point, the IRS can begin collection actions, which can include filing a federal tax lien directly against your property. The 7-minute mark, the decision that is costing the most. This is the moment we told you about at the beginning. The one decision millions of seniors made with genuinely good intentions to protect their home and provide for their family, that is now generating some of the most devastating and unexpected tax consequences in the country. Inherited property documentation gaps. When you inherit property, whether it is your deceased spouse's share of the family home or a vacation property from a parent, the tax code provides one of its most generous and valuable benefits, the stepped-up basis. Your cost basis in the inherited property is reset to the fair market value at the date of the original owner's death, not what they paid for it decades ago. This benefit can eliminate or dramatically reduce the capital gains tax you would otherwise owe when you eventually sell the property. For many families, it represents hundreds of thousands of dollars in tax savings, but the stepped-up basis only delivers that benefit if it is properly documented at the time of inheritance. If the estate did not obtain a qualified professional appraisal at or near the date of death, if no records were created establishing the fair market value of the property at the time you inherited it, if no Form 706 was filed for estates that met the filing threshold, then you are holding property with an undocumented cost basis. And under the IRS's current enforcement posture, an undocumented basis is treated as a zero basis until you can demonstrate otherwise with credible documentation. Here is what that means in practice. If you sell an inherited property for $300,000 and cannot produce documentation of what your stepped-up basis should have been, the IRS can assess capital gains tax as though your basis were zero. On $300,000 of recognized gain, taxed at a long-term capital gains rate of 15% to 20%, that is a tax bill of $45,000 to $60,000 on a property you inherited that you never paid the original purchase price for, because nobody told you that an appraisal needed to happen at the time you received it. The IRS is now actively identifying inherited properties through estate filing records and probate court data, and matching those records against subsequent sale transactions to determine whether proper basis documentation exists on file. Did you inherit property in the last 10 years without a professional appraisal being completed at the time? Drop a yes in the comments below. The 5 steps to protect yourself before this reaches your door. Step 1. Gather every document connected to your home going back to 2022. Start with your original closing disclosure from when you purchased the property. Then compile records of every significant improvement you have made: a new roof, a kitchen renovation, a bathroom remodel, new windows, and HVAC replacement. Under IRS Publication 523, the cost of permanent improvements increases your cost basis in the property, which directly reduces your taxable gain when you eventually sell. Many seniors have invested tens of thousands of dollars in improvements over decades, but have no organized records to prove it. Then locate any home equity loan or HELOC statements, including the original loan agreement and anything that shows what the funds were used for. Find any deed or title documents that reflect ownership changes. And if you have rented any portion of your home, pull your rental income records and any platform payment statements. This is your starting point. You cannot identify whether a problem exists until you know what documentation you actually have. Step 2. Compare your last 3 filed tax returns against those documents. You do not need to be a tax professional to do this initial review. You are simply looking for obvious gaps. Things that appear in your documents but are absent from your returns. Did you take out a home equity loan, but your return contains no mention of how those funds were used? Did you change your deed, but you have no Form 709 in your records? Did you receive rental income, but there is no Schedule E on any of your returns? Did you sell or transfer inherited property, but there is no Form 8949 or Schedule D? At this stage, you are not solving anything. You are simply determining whether a discrepancy exists that needs to be addressed. Step 3. Create a free account at irs.gov and pull your tax transcript. Your transcript is one of the most powerful and consistently underused tools available to any taxpayer, and it costs absolutely nothing. Your transcript shows every return processed under your Social Security number, every notice or assessment that has been issued against your account, and every piece of third-party data reported to the IRS and matched to your records. Every 1099-K from rental platforms, every lender report, every deed-related data point your county shared with the federal database. This is how you stop guessing about where you stand and start knowing with certainty. Setting up the account takes approximately 15 minutes through the ID.me verification process. Once you are inside, you can see exactly what the IRS sees when they look at your account. Step 4. If you identify any of the 4 triggers, consult a qualified tax professional. Specifically, you want either a certified public accountant or an enrolled agent with demonstrated experience in real estate taxation and IRS penalty procedures. When you call, ask this specific question. Do you have experience with IRS penalty abatement for real estate-related compliance issues? That single question tells you immediately whether you are speaking with someone who has the right background for your situation. Step 5. If you have received any IRS notice that you have not yet responded to, address it immediately. Every notice carries a specific response deadline. An unanswered CP 2000 does not quietly go away. It escalates into a statutory notice of deficiency. That becomes a final assessment. A final assessment becomes an active collection matter, and a collection action can become a federal tax lien recorded against your property. That entire progression unfolds over a period of months, but every step along the way makes the situation more complicated and considerably more expensive to resolve than the one before it. A critical warning about scammers. One final piece before we close, and this is important. Every time high-profile IRS enforcement news begins circulating that affects seniors, fraudulent activity follows within days. Phone calls from people claiming to represent the IRS demanding immediate payment. Emails carrying official-looking agency logos asking you to click a link or provide personal information. Companies promising to make your tax problems disappear entirely in exchange for a substantial upfront fee. Here is what you need to know about how the real IRS operates. The IRS initiates contact through United States mail only. They do not call you demanding immediate payment over the phone. They do not threaten arrest for unpaid taxes in a phone call. They do not accept gift cards, wire transfers, cryptocurrency, or any form of payment other than official IRS payment channels. If anyone contacts you and creates urgency around immediate payment or the immediate disclosure of personal financial information, end the call. Then verify your actual account status directly at irs.gov or by calling the IRS directly at 1-800-829-1040. Have you done any of the 4 things we covered today? Taken out a home equity loan, changed your deed, earned rental income, or inherited a property without ever discussing the tax implications with a qualified professional? Leave your situation in the comments right now. Real questions from real homeowners shape exactly what this channel investigates next. Everything covered in this video is documented in IRS Publication 936, IRS Publication 523, the Form 709 Instructions, and Internal Revenue Code, Section 1014, and it is already generating notices for senior homeowners across the country right now. More investigations are coming. Subscribe so that information reaches you before the notice does. The system has rules. You deserve to know what they are.